blockchain is real, it's a technology.
Wall Street doesn't just like Bitcoin.
$48,000 level.
Like 60 billion.
Let's get in.
Now, before delving into the major role of those institutions, let's get into why it matters, them getting into blockchain. There are four main elements why they are the main drivers of this technology. First, trust. Those institutions have been decades in the industry and they have like a huge user base. From that perspective, they bring a huge value in terms of trust and credibility to the market, which will assure the average trader and investor reasonable credibility. Also, they provide capital. Those institutions have a huge amount of funds, be it from retail investors or even other institutions. They provide a huge capital into the market. And third, security. One of the major concerns when it comes to institutional-grade solutions is security. From that perspective, institutions provide a really good infrastructure when it comes to secure infrastructure, either to invest or to provide value to end customers. Moving forward with tokenization and collateral movement, how do you think the big boys, Goldman Sachs, BlackRock, JP Morgan, be it sell side or buy side, are going to interact with the blockchain? And what do you think that trend is going to be?
Yes, that's a very important question because it's getting at the heart of one of the hot debates, though I feel it's kind of faded away a little, private chain versus public chain, right? And you still see today a handful of financial institutions, both public and private institutions, right? Mentioning and continuing to put resources on efforts centered on private chains. So from discussions I've had with them and from my own opinions, the view I have is you need to separate where we are today because of past dependency in projects pushed by those institutions from fundamentally what the better choice is, right? Institutions do not move at the speed of startups. They cannot and they should not. So when a project starts and you're thinking about a project to revisit how payment and cash operates, and you're talking about tokenizing deposits and migrating, legacy payment rails in wholesale and private money circulation to a blockchain rail, this probably started 4 or 5 years ago. 4 or 5 years ago, as a regulated entity, it would have been very challenging to defend using public blockchains. So 4 or 5 years ago, you started with a private chain.
Exactly.
The pace at which you move is such that today you are now running pilots in production and you are running some small subset of your business in production, still using that legacy that was the onset of your work on the private chain, right? But when you take a fundamental assessment of private versus public, you need to basically look at, from the standpoint of an institution, the cost of maintenance of the core infrastructure. And you could say, well, it's done by a third party, which is a private company. Yes, sure. Doesn't matter. That private entity needs to maintain an entire blockchain software stack, not just the blockchain DLT itself. You need to keep up with smart contract standards and have your own smart contract standards. You need to keep up with DevOps. You need to keep up with everything which is going to be software used to monitor in production your applications, right? Debuggers, compilers, you name it. That's a huge endeavor. Well, against you as a competitor is an open source initiative with tens of thousands of the best developers in the world, right? That to me is just a lost cause for the private blockchain companies. So then you think about a JP Morgan and a BlackRock, you're like, okay, on one side, there is this private thing, right? Versus the public one. Either way, I'm going to pay. But in one case, I'm paying for something that's always going to be current, top of line, because that's what open source gives you. And we have enough validation from open source initiatives in databases technologies, in machine learning technologies, to know that this is a very challenging route to compete against, right? Now, some of the pushback you will hear, and I think some of them come from a confusion and an assimilation. They will tell you, I'm regulated, I'm doing very sensitive transactions. I cannot have all of that being public. you need to make a distinction between using open source technologies and everything being public, right? So yes, sure, if your transaction is executed on Polygon, someone going on the Polygon DLT will be able to see the transaction, but the transaction will essentially be a wallet with a hash and a gas fee, right? You could see what smart contract is going to be used. You could infer what the smart contract is doing, which is going to be some form of moving money and moving assets, right? But you actually have a degree of protection of the sensitive information that today is absolutely achievable. You bring into the picture decentralized identity. You bring into the picture zero knowledge. You bring into the picture homomorphic encryption, right? You bring into the picture multi-chain systems with bridges where you can actually have your cash leg and your asset leg, or each party to a transaction, be on a parallel track, reconciliated, right, through a bridge, reconciliated through a smart contract. You actually get extremely good protection of the information you care about protecting. So really, when you take an assessment of where we are today, things you can do on an open source blockchain architecture can simply not be competed with from the private realm side. So then it's a matter of like what gives for the change to start happening, right? The opinion I have on the subject is most institutions, if not all institutions, will not do the work internally. They will partner. Right now, you mostly see partnerships between some layer ones or layer twos and some institutions, right? And then once in a while, they bring in a tokenizer, and tokenizers is a long conversation on the right way tokenizers should think of themselves. But a layer one or a layer two is actually not the right partner. It's like saying, okay, BlackRock or Goldman Sachs is going to partner with Microsoft Azure to go rewrite their pre-trade, post-trade system. And I'm like, I mean, if I'm telling you that, people are going to laugh. But this is what they are doing today. They are partnering with the layer one, layer twos, they are the main partner that comes to mind today. They are not the adequate partner. The adequate partner are going to be market infrastructure startups, right? But for those two worlds to interface, you need to make sure that the startups in question, not just at the technology level, but at an operating level, have the level of quality, have the level of resilience where institutions will feel comfortable engaging. And to do that, you need those startups, among other things, to have sufficient backup from investors, that they have a few years of visibility, that they have access to executive, to leadership level at institution for that trust, that initial trust to be there for the conversation to start, right? With a view of, okay, yes, indeed, you are capable of working with us. Therefore, I'm going to commit serious resources to a pilot with an eye on production within a year and a half, 2 years.
For the good old American life, for the money, for the glory, and for the fun, mostly for the money.
Institutions are not anymore just observing on the sidelines and waiting for major events to happen to interfere. Actually, institutions today are operating on blockchain. We have for JP Morgan, their famous private blockchain called Onyx that already has transferred billions of dollars on blockchain. Also, we have like collaborations on POCs between Apollo and Wisdom Tree. Institutions are already getting there. Maybe it's slower than expected. Yes, it's a new technology, but we are getting there. Now let's see the major trends when it comes to those institutions. And what is the winning trend today? Now moving from B2B institutional world, more like B2B2C, where more like corporate banks. Like I always imagined in my head one day we'll reach a level where like Compound meets Chase, where you can able to get like instant loans, you can leverage, you can like earn yield without any complexities. How can you see this more like US level, like the world's most regulated country when it comes to banks and financial institutions? How can you see Compound intersecting Chase, cooperating, or even like more hybrid model?
So I don't know that Compound will ever intersect Chase without a meaningful rethink of Compound, because they operate right now unregulated brokeraging and lending, right? But that's DeFi. So I'm not saying they're doing anything illegal. I'm just saying in the context of Chase business, they cannot in their current shape, right, combine. But I think really what you're getting at is how does DeFi intersect TradFi, not just blockchain intersect TradFi, but DeFi intersect TradFi. And the way I like to approach that question is, when we speak about decentralization, what are we really pointing at when we say it's decentralized? Are we saying we decentralize unit economics? Are we saying we decentralize governance? Or are we saying we decentralize technology and the product in its most basic form, right? TradFi is not against decentralization of technology. And most of TradFi are already public companies. They are therefore publicly listed. There is a fairly decentralized unit economics. Pretty much anyone, unless you're blacklisted, can buy shares, for example, of JP Morgan, and they will get a dividend. So they will share the unit economics, and they are allowed to vote and participate in the shareholder meeting. So there is some form of decentralized governance, right? But where I think TradFi is uncomfortable with is the assimilation of decentralized with permissionless, because that gets you into regulatory trouble. I think they're also uncomfortable with decentralized being pushed to the extreme, which is everything needs to be decentralized. And unfortunately, that is not how businesses operate. You have people with specific expertise who should make decisions in the corresponding domain, right? Should random people across the world contribute on equal or pro rata governance token footing basis in the strategic roadmap decisions of JP Morgan? No, they shouldn't, right? Should I contribute to decisions on legal matters? I mean, maybe I can offer an opinion, but I am not a trained lawyer. Could I contribute to decisions pertaining to the wealth management business or pertaining to FICC trading? I'm qualified for that, right? So this is an example of stratified governance, where the extreme philosophy, in DeFi wouldn't work. So in my view, all of that, beyond providing context, all of that to say that, yes, I think there is a hybrid model where a lot of services today, whether through a bank or an asset manager or a payment institution, a lot of services are actually fairly fragmented in the background. They could be fragmented in terms of how many steps I need to take to eventually have what I need to do done. They could be fragmented in terms of how much time does it take for this to complete, right? It could just take me one click to do it, but for the service in the backend to actually complete could be a month, right? Yeah. They could be fragmented in terms of eventually how much it costs me to do. Cross-border payment is a great example, right? You want to send money from the US back to your family abroad. For many regions, that's 2 weeks and 5 to 10% cost. Not because it's actually that expensive, but because you have to go to correspondent banking network, whose technology architecture is, again, more than 2 decades old. So you have a lot of fixed costs. And that's why for a bunch of geographical corridors, it takes you 2 weeks and 5 to 10%. Right? To me, this is where the hybrid model is going to come in. I like to think, for example, of Curve Finance as the future of foreign exchange markets, because the ability to move risk in a fully automated manner, in a programmable manner, in an interoperable manner, with full traceability on Curve is unmatched.
Interesting.
So that's where I see kind of the world converges. Some of those projects may remain pure crypto. I think some of them will. I think in a couple of years, there is no such thing as this is crypto and this is TradFi and this is right. No, there is finance. You have several asset classes. One of them is crypto. And then you have companies who decide to cater to crypto, just like you have companies catering to equities and fixed income and currencies and commodities, and it will be a much more holistic view of the space. And so when you will move to the market infrastructure, you will say, okay, within market infrastructure, what asset classes are you covering? And what use cases on these asset classes are you covering? And so this is, to me, where the hybridation will come in versus today, what's, that unneeded separation. Dollar is not legal tender.
Really speaking, for many of us who have no idea, what is this world about?
You have highly specialized blogs and podcasts. You are an example.